Since the 1400s, there have been 6 world reserve currencies. This means that a world reserve currency lasts for roughly 100 years, and today, the US dollar is approaching the tail end of its 100-year timeline. This is one of the many reasons why the IMF recently released a paper which explores the decline of the US dollar and the different currencies that could rise to replace it. Today, I'm going to give you a bit of background about the IMF and its paper, tell you what it says in simple terms, and explain how Bitcoin could indeed become a world reserve currency. Before I talk fiat, we need to have a chat. Nothing in this video is financial advice. Got that? It's just entertaining educational content that's filled with facts. Please contact a financial advisor if your portfolio is looking slack. If this is your first time around these parts, my name is Guy and crypto is my art. I create high-quality crypto content that will help make you smart. Coins, tokens, news, reviews, and all those lines and indicators you see on price charts. If you want to take part, subscribing to the channel and pinging that notification bell is the best way to start. If your time is running low, you can skip ahead using the timestamps below. Just don't forget to smash that like button before you go. That's all you need to know about the Coin Bureau. Let's see what the IMF is saying about the US dollar and what it could mean for crypto. If you're unfamiliar with the IMF, here's what you need to know. The IMF, or International Monetary Fund, is an international financial organization consisting of 190 countries. The IMF's official mission is to ensure financial stability around the world, but the IMF's definition of financial stability is almost synonymous with the dominance of the US dollar. This is because the IMF was established as part of the Bretton Woods Conference in 1944, where 44 countries came together to agree that the US dollar would become the world's reserve currency. More accurately, these 44 countries agreed to peg their currencies to the US dollar, which would in turn be pegged to and exchangeable for gold. As pointed out in a recent opinion piece by CoinDesk, the IMF's practical purpose has been to integrate as many countries as possible into the dollar-denominated Western economic order. The IMF does this by issuing loans to developing countries, primarily countries in Africa and Latin America, and particularly those that are facing economic hardship. This is mainly because some African and Latin American countries have a history of siding with, shall we say, enemies of the Western economic order. To ensure these countries align themselves with Western interests, IMF loans come with a series of conditions that include stuff like deregulation, so that Western corporations can do business there. Ironically enough, this has done more harm than good, and many countries in these regions have subsequently turned to Eastern powers for their funding, primarily China's Belt and Road Initiative. As you might have guessed, the IMF is not a fan of cryptocurrency whatsoever, and this is simply because it allows individuals and institutions to break away from the Western economic order. The IMF has been especially active in speaking out against the adoption of cryptocurrency by countries ever since El Salvador adopted Bitcoin as legal tender last year. The IMF seems to be very concerned that this could happen elsewhere because it recently renegotiated a loan it had issued to Argentina in 2018, and one of the conditions of the renegotiation was to discourage the use of cryptocurrency in the country. It should come as no surprise then that the IMF's recent paper about the decline of the dollar's dominance makes no mention of cryptocurrency. As you'll see, however, this doesn't mean that there's no room for cryptocurrency to play a role in the changing economic order, and Bitcoin unironically appears to be a top contender for the title of world's reserve currency. Now, the IMF's paper is titled, quote, "The Stealth Erosion of Dollar Dominance, Active Diversifiers and the Rise of Non-Traditional Reserve Currencies." And it was published on March the 24th. Besides the general decline in the dominance of the US dollar over the last few decades, the recent sanctions against Russia's central bank in response to the country's invasion of Ukraine is probably another reason why the IMF released this paper. You can find out exactly what these sanctions were and what effects they could have on you using the link in the description. As for today's paper, I'll give you my thoughts as we go along, so sit back, relax, and admire your stack of sats while you listen. The IMF's paper begins by explaining that the appeal of the US dollar to the global economy has been on the decline ever since the collapse of the Bretton Woods Agreement. This happened in 1971, when then-President Richard Nixon announced that the US government would be, quote, temporarily suspending the ability for individuals and institutions to convert dollars to gold. Some analysts argue that the Bretton Woods Agreement had collapsed many years before, when other countries started to suspect that the US government didn't have the gold it needed to back the dollars in circulation. In any case, the authors of the paper explain that the dollar remained the world's reserve currency despite the collapse of Bretton Woods, because there were basically no alternatives. However, over the last couple of decades, currencies like the euro and the Chinese renminbi have emerged as potential contenders, mainly because of how widespread these currencies have become. That's thanks to their international funding programs, such as the aforementioned Belt and Road Initiative. The authors specify that the paper centers around the composition of international foreign exchange reserves held by central banks, i.e., how much currency they're holding that's not native to their respective countries. As you can see, the number of US dollars held by central banks has fallen from 71% in 1999 to 59% in 2021. And the authors believe this has nothing to do with countries trying to move away from the dollar. Quote, rather, it reflects active portfolio diversification by central bank reserve managers. They believe this because central banks haven't been accumulating the currencies you'd expect them to, namely the euro, Japanese yen, and British pound, the currencies that were once seen as runners-up for the role of world reserve currency, and the currencies that are part of the so-called Big Four. Instead, central banks have been accumulating other so-called non-traditional currencies, and the authors estimate that only about a quarter of this alternative allocation has ended up in the Chinese renminbi. The remaining three-quarters of foreign exchange reserves consist of other currencies. Interestingly, the authors cite technologies such as the automated market-making mechanisms you find in DeFi and the currency swap protocols of fintech platforms like Wise as the reason why this is happening. Put simply, you no longer need the US dollar to trade efficiently between foreign currencies. These technologies allow you to do so directly in an efficient manner, and this lowers the demand for US dollars overall. Put differently, the need for holding US dollars historically came from the dollar's role as the de facto stablecoin of the fiat world, and now that direct conversions are possible between different currencies, the dollar's role has been diminished in that realm. The authors also identify the accumulation of more speculative assets like stocks and the lack of attractive interest rates for government bonds from the United States and other governments as a reason for reducing central bank exposure to US dollars. This begs the question of what effects the trend of central bank diversification will have on the US dollar and global economy, and this is the exact question that the authors aim to answer with this paper. Anyways, the second part of the IMF paper analyzes a few additional factors that could be contributing to the US dollar's decline. The first is the size of the US economy as a share of global GDP, which has been on the decline, and the second is the percentage of global exports that are destined for the United States, which has also been on the decline. If you're wondering why that second factor is so influential, it's because when an individual or institution buys something outside of the United States, they pay for it using dollars. This leaves the recipient at the other end of that transaction with dollars, which conveniently leads to the widespread use of dollars around the world. Some analysts argue that this is part of why the United States has transformed itself from being a producer to a consumer over the last few decades. It leads to the global distribution of dollars. The more you know. The third factor the authors consider is the strength of the US dollar, which has actually increased over the last decade or so. The authors believe this is a sign that the US dollar is still in demand despite its decline. The fourth factor seems to explain why the US dollar is still in demand, and that's the amount of dollar-denominated public debt, which has been on the rise over the last 2 decades or so. I suspect that you can thank the IMF for that one. The fifth factor is somewhat surprising, and that's the aggressive accumulation of US dollars by the Swiss and Chinese central banks. Because there's a limited amount of dollars to go around at any given time, the authors speculate that this aggressive accumulation could be making it hard for other central banks to get their hands on dollars, or at least that's what I understood. The final factor the authors analyse is all the central banks with excess reserves. In short, some central banks have more money on hand than they need, and they're investing this money in assets and currencies outside of the US dollar. This reminds me of how the Federal Reserve started buying corporate debt with the help of the Treasury Department at the start of the pandemic, and you can find out what the Fed is planning next using the link in the description. I digress. The third part of the IMF paper analyses the composition of central bank reserves over time with statistics, and I won't bore you with the maths. The main takeaway is that the 2008 financial crisis seems to have accelerated the move away from the US dollar, and this makes a lot of sense. That's because 2008 was the first time the Federal Reserve was forced to print trillions of dollars to prevent the global markets from imploding. This obviously devalued the dollar. It also set a dangerous precedent, and that's that the Federal Reserve will do the same and more in the future if there's another market crash. As I mentioned a few moments ago, this is exactly what the Federal Reserve did at the start of the pandemic, and it has led to record levels of inflation in the United States and elsewhere. Not only that, but the author's statistical analysis revealed that the size of the central bank has no effect on its likelihood of accumulating non-USD currencies, which suggests that the trend away from the dollar is truly global and not limited to smaller or larger countries. This moves us on to the fourth part of the IMF paper, which analyses whether country-level factors are playing a role in the move away from the dollar. This includes how countries peg their currencies, how much external debt they have, whether they're a net importer or exporter, what currencies they use for trade, and inertia, which can simply be summarised as fiscal and monetary policy, i.e. interest rates, taxes, and government spending. As expected, any countries that peg their national currencies to the US dollar have a much higher chance of having larger US dollar reserves. Frequent trade with the United States has the same effect, as does using US dollars as the primary currency for international trade. Oddly enough, the other factors are apparently having next to no effect on the dollar holdings of central banks. And the authors also discovered that countries within the Eurozone have a higher likelihood of having large dollar holdings on their respective central bank balance sheets. The end result is this figure here, the determinants of whether a central bank will hold a large amount of dollars, with a USD currency peg being first at almost 60%, trade with the United States coming in second at around 20%, Eurozone status at around 15%, and dollar debt for the rest. Speaking of debt, if you're wondering just how much debt the world is in, you can find out using the link in the description. Anyhow, the fifth part of the IMF's paper is the one that relates the most to cryptocurrency, and that's because it's all about the rise of, quote, non-traditional reserve currencies. The authors start this section with a crazy statistic, and that's that the dollar value of non-traditional currencies on central bank balance sheets has ballooned from 30 billion in 1999 to over 1.2 trillion today. If my mental maths is correct, that's a 20x. Non-traditional currencies now account for 10% of central bank balance sheets, and you'll hopefully recall that isn't far off from the 12% decline in their US dollar reserves over the same period. The authors reiterate that 2008 was when the trend towards non-traditional currencies really took off, and a table shows which currencies have taken the largest share of the pie. These are the Australian dollar at 20%, the Canadian dollar at 23%, the Chinese renminbi at 25%, the Swiss franc at 2%, and the remaining 29% in other currencies, primarily the Korean won, the Swedish krona, the Singaporean dollar, the Norwegian krona, and the Danish krona. The authors note that the surprising underrepresentation of the Swiss franc suggests that the choice of non-traditional currency comes down to interest rates. Interest rates in Switzerland are the lowest in the world at negative 0.75%. Yes, you heard that right, negative. That's called getting paid to borrow. Now, for context, the Swiss franc has long been seen as one of the best currencies to hold because of the Swiss central bank's robust monetary policy and the country's neutrality in global conflicts. But it looks like the golden age is over in both regards. Not surprisingly, the central banks of China, Switzerland, and Russia have the largest absolute holdings of non-traditional currencies by dollar value. In percentage terms, the central banks of Lesotho, Namibia, and Malta have the largest holdings of non-traditional currencies by dollar value, and I'll quickly point out that Malta is a crypto hotspot. As the authors mentioned in their introduction, new technologies such as AMMs have increased the liquidity and accessibility of swaps between non-traditional currencies, and this is part of why they've become so appealing to central banks. Another reason the authors briefly mentioned in the introduction that I didn't mention earlier is the Sharpe ratios associated with non-traditional currencies. For those unfamiliar, the Sharpe ratio is used to measure the risk-adjusted return for any asset. As you can see, the Sharpe ratios for non-traditional currencies are pretty damn high, particularly for the Chinese renminbi. This means it's a profitable currency to hold. The Sharpe ratio of the US dollar is much lower, and the Sharpe ratios for the euro, Japanese yen, and the British pound are effectively negative. In crypto speak, these three fiat currencies have bad tokenomics, and you can find out why tokenomics can make or break a crypto project by using the link in the description. Anywho, the sixth part of the IMF's paper analyzes possible reasons why central banks have been dumping the dollar in favor of non-traditional currencies. Most of these boil down to the way that central bank foreign exchange reserves are being counted, specifically the effects of counting central banks that hold very few US dollars, how central banks are reporting their foreign exchange reserves, exchange rate effects, and interest rate effects. The short of it is that they didn't find much evidence that this is contributing to the effect they're seeing. The final reason the authors entertain is central bank balance sheet rebalancing and diversification. This is where they finally find some significant evidence, but they stop short of saying why central banks are diversifying in such a manner. The paper finishes off with a short conclusion, and the point of focus seems to be the narrative that the Chinese renminbi is replacing the US dollar, which the authors dismiss based on the evidence they presented. In sum, quote, all this suggests that if dollar dominance comes to an end, then the greenback could be felled not by the dollar's main rivals, but by a broad group of alternative currencies. The authors also emphasize that the end of the dollar is not a prediction, but just a scenario. And the fact they had to say this at all speaks volumes to where the wind is blowing, so to speak. Now, this brings me to the big question, and that's how Bitcoin could become a reserve currency. For starters, it's clear that central banks are ditching dollars for non-traditional currencies. I reckon it's reasonable to assume that they're doing this because the biggest fiat currencies are on their way out, including the US dollar. The threat of sanctions certainly isn't helping either. In addition to being a non-traditional currency by definition, Bitcoin's market cap isn't far off from many of the non-traditional currencies being held by central banks. For example, Canada and Australia's total M1 money supplies are less than 2 trillion each, and though Bitcoin isn't there yet, it probably will be in a few years' time. Moreover, many of the monetary technologies that are making it possible to effectively swap between non-traditional currencies are being improved, if not outright created, by the crypto industry. While BTC probably doesn't fit too well within the existing foreign exchange framework, this could also be the case in a few years' time, especially as assets increasingly become tokenized, including fiat currencies. As a cherry on top, Bitcoin is neutral money, meaning central banks won't ever have to worry about their BTC holdings being frozen or their BTC transactions being blocked by foreign countries. Never mind the fact that there are many countries considering making Bitcoin legal tender, and some are even considering accepting BTC as payment for international trade, which is another reason why central banks hold dollars on their balance sheets. As such, I predict that BTC will eventually find its way into the non-traditional currency category, assuming the IMF counts it as a currency, of course. Once that happens, it's quite possible that BTC's share of this non-traditional currency pool will increase in a similarly exponential manner as non-traditional currency holdings on central bank balance sheets. This means a 20x increase over a 20-year period, and that would likely translate to a Bitcoin market cap in the tens of trillions of dollars, which is roughly the M1 money supply for the US dollar. Not to mention that the pandemic money printing has probably accelerated the transition to non-traditional currencies, and the next financial crisis will certainly add fuel to the fire. Now, I know this may sound crazy, but assuming all of my assumptions are correct, this means BTC could become a serious contender for world reserve currency status sometime between 2040 and 2050. And this coincidentally lines up with the projected end of the US dollar status as the world's reserve currency. I personally believe that this is possible, but I know there's a long way between point A and point B, and we're almost certainly going to see a lot of volatility in the meantime. And that's about all for today's video about the inevitable death of the dollar. If you learned something new, smashing that like button is the right thing to do. Be sure to subscribe to the channel and ping that notification bell too so you don't miss the next video that hits the tube. Until that time, you can check out Coin Bureau clips for more or tune into the Coin Bureau podcast when you're doing chores. You can also find me on Twitter, TikTok, and Instagram, and stay up to date with the crypto market by joining my Telegram. My weekly newsletter is where I detail my crypto plans, reveal my personal crypto portfolio, and give you other valuable info. If you want to let the world know that you're a fan of crypto, then head on over to the Coin Bureau merch store. You can find your way there using the links down below. Thanks so much for your time. Guys, all out of rhymes, so it's time to say goodbye.